All right, everyone, welcome to the Rental Roundtable. It's the first time we've had two guests on here. Excited for this episode. So, Michael and David, welcome to episode number 27.
We're very glad to be here. Thanks for having us.
Yeah. So, Michael, you're in New York. David, you're normally in Atlanta, where I am, but today you're in a closet. I appreciate you being dedicated to the episode today.
Indeed, happy to. Yeah, it's a little change of pace, surroundings.
Yeah, and I started my career in our Atlanta office, so I was there throughout college and for the first few years of my career, and then moved here in 2019. So I've got a lot of fond memories of Atlanta, and I'm definitely due for a trip back there soon.
Yeah, it's a great place to be. So for today's episode, obviously, we're going to talk about M&A trends, talk about the evolution of rental from an M&A perspective, and really talk about that in detail today. But maybe, Michael, for you, then go to David next. Just for the audience, tell us about your background, in particular, how long you've worked with, rental companies, dealerships, and sort of your experience working in this particular industry.
Sure. Originally I'm from Maryland, went to school at Emory in Atlanta, and then started with TM Capital full-time back in 2016. So I've spent my entire career thus far at the same firm. In investment banking, and at this point now I'm 8 years in, and now vice president sitting in our New York office, and really started my career more as a generalist, as many do in this sector, in this category. But about 2-3 years ago, after having done some work in the equipment rental space, one of my first transactions I got to work on was we represented the Zajic family in the sale of Norris Sales to United Rentals. And that just gave me kind of a great entree into the equipment rental category. Just love the people that you get to work with in this space, get to work with a lot of privately owned businesses. And it just kind of got me hooked. And who doesn't love, big pieces of construction equipment as well. So now I'm a couple years into that and really fully dedicated at this point. So working alongside David, who really leads our efforts in equipment rental and dealer on every bit of work we do there, our sector reports that we've written, and all of our ongoing coverage.
Well, Kyle, maybe from my side, so David Phelps, actually this August, I turned the odometer on 38 years of investment banking, started in New York in 1986. Started out life actually in the leverage buyout booms of the late 80s. And that actually turns out to be pretty applicable here, because one of the great elements, one of the reasons why financial investors ultimately, when we get around to that, kind of like this sector, is the ability to have, fairly substantial, lending support, equipment finance behind your fleet. And so therefore you can kind of magnify when things go well, right? You can kind of magnify your cash flow and your returns if you manage that correctly. And so, so I started out, if you go back to the 80s and 90s, M&A was a generalist category. It's now more specialized. But through that time, a bunch of years ago, I had the opportunity to work with a private equity group that owned two actually aerial equipment rental businesses, one in the Gulf, one in the Midwest. And because of the relationship, we had a chance to work with them, learn that category, got to see under the hood kind of the power and the resiliency of rental models when they're done well. And to kind of joke, if you have an investment banker and they've done 2 deals in a sector, now they're an industry expert. And so we were able to parlay that years ago into, Michael, what is it, 15 deals over the last 40 or 42 months. And we've built the largest, middle market M&A advisory practice, mostly sell side, but occasionally helping, especially financial buyers, look at dealers or equipment, spanning construction equipment and dealer. And we love all the conversations, and we really do love, kind of candidly, evangelizing this sector to more and more investors who we think still, to a vast extent, underestimate the value of these businesses.
Yeah, that's great. And your sort of comment about two deals in a sector, you're an expert. 15 deals in the last 3 years, $2.6 billion of enterprise value on those deals. So 15 deals that make you like Tiger Woods or Michael Jordan, I guess.
Yeah, we'll stay humble. We, like I said, it's still a competitive world, and we need to work hard with companies that we come in contact with or search us out just to help them make sure that we're the right fit for what they want to do.
Yeah. So,
and I would also just add that, kind of if you look across those deals, our main focus is really to provide clients with options. So there's not really any particular bend in one direction versus another of, only strategics acquiring those companies or only private equity. It's really kind of a healthy mix so far. And we've really been focused on trying to expand the number of financial investors that are interested in the rental space as well.
Sure. And we've done, I said, 27 episodes, mostly rental operator, technology players, marketing leaders. The first time I had bankers on, and now you've said 15 deals in 3 years. What about the rental industry is attractive to you guys? You guys, the second deal maybe is a coincidence, but 15 deals, you have become the leaders in this sort of segment. What do you guys enjoy working in the rental industry? Like, what are the things about the industry that you really enjoy?
Well, Michael, maybe I'll jump in there. First of all, it remains a category where entrepreneurs and customer service can win, right? I mean, there's no small rental business that can buy equipment as effectively as a United or a Sunbelt, right? They just can't. I mean, they can get close, but pound for pound, you don't have the buying advantages. You don't have the scale economies of running billions of dollars worth of revenue through one CEO versus, a smaller business still with a CEO or an owner of the business. But what we love is that even today in 2024, and even with the consolidation that has happened to date, the number of independent players out there that kind of go to work every day and win with their customer base, keep those customers, grow their customer base, serve that customer base. It's competitive, but it's competitive in a way where ultimately, we always use the word equipment rental service, because at the end of the day, it's a service. It's not, just delivering a piece of equipment. And some of that service is on the front end, right? What do I need? But a lot of that service is something's gone wrong, and can it be fixed quickly, right? And those independent rental players who have built that reputation and have that loyal customer base create a lot of value, in their community, in their network. And then ultimately, if they decide to seek liquidity. So we love that entrepreneurs can win, small businesses can still grow to nice sized businesses, can continue to grow to even large sized business, even in a world where you've got very large multi-billion-dollar revenue, companies. Still, the smaller and mid-sized players can show up and compete. We love that. But as M&A bankers, we need, you need both sides of a trade, right? If somebody's interested in exiting, then we need a world where there are people that are interested in exploring some type of liquidity event, be it a full sale or a substantial sale, or possibly they're looking to buy somebody else and need some help with that. But we also need the other side. Is there a buyer universe for that? And what we love about this sector is the vast, still thousands of companies out there that, get older over time, have life events, have business elements like, the need to continue to reinvest in fleet or maybe make some technology investments. And they may say, you know what, I was kind of thinking about maybe slowing down or retiring. And now with a big capital investment into my business required, maybe now's a good time to just go on and explore. So you've got a vast number of folks that have created value, good value for themselves and their families. And you have a vast number of large strategics, mid-sized strategic buyers, kind of what we call in our report, some of the next gen, consolidators that are coming up and are quite sizable now. But then also a vast number of private equity firms and financial and family office investors who really have the ability to kind of custom tailor an outcome. And so we've got kind of a lot on the supply side, being companies out there, and a tremendous amount of demand. And that's a wonderful environment to be an investment banker and try to find the matches amongst those two groups.
I love that. And one thing you mentioned was consolidation, which I think, there is a that's something that people talk about, right? I think the ARA puts out what percentage of the locations are acquired every year. There are more locations acquired in 2023 than 2021 and 2022 combined. And there's a stark view that 10 years from now, Sunbelt, United, Herc, Home Depot, that's it. And there's no independents left, right? I don't subscribe to that. I think that's overstated. But that is, the nationals are buying players, and they're going to continue to. So I guess one question is, maybe just take me back, talk about sort of the evolution of rental from an M&A perspective, going back, 10, 15 years, sort of where we are today, and where does that go in the future? And sort of with your crystal ball, what does the consolidation look like in the rental industry?
Yeah.
Sure.
Go
ahead, David.
Well, I was going to say, maybe on the history part, look, there was a day when we didn't have consolidators, and you had, a Wade Heidsinger who had been very successful on the waste side to look at another fragmented industry and say, can we, execute a similar plan? We know a variety of rental equipment owners today that have built, their second businesses over the last 30 years after selling into the first wave. Mm-hmm. And I think the first wave, and we were not active, we were not nearly as active in the space way back when, if at all. But there's some horror stories out of that, right? In the early days of that, the OEM world, the dealer world, the scale of the consolidator, some of this was just buying a bunch of things quickly and putting it under kind of one banner. And some of those deals really didn't work. Some of those deals ended up in bankruptcies. Some of those really had to start over. And so you have a choppy early days of consolidation, and imagine a world where you have no financial investors that are thinking about this category, at all. First of all, if you go back 30 years, there's not really a private equity community, and there's really nothing like today's professional family office investors. So you saw an industry that has a large number of small players, only a few consolidators, some of that starting to go a little bit rough, right? In the early days, some good, some bad. And then it becomes a little more mature, right? And so now you fast forward, but even there, if you look at, a United and a Sunbelt, right, who have remained very, very active buyers, you take one step below that scale just a few years ago, a Sun State under Sumitomo, really organically focused, not doing very many acquisitions at all. A Herc for, once it's separated out, and Larry really focused on getting that business, kind of fully integrated and standalone and optimized. And then they became a voracious acquirer of over 30 deals back in 30 from just a couple. And a couple of years before that, H&E had not really been an acquisition player, and started to get more active there. So even though you've got several big players, even some of those were not as active in consolidation as they are today. I mean, today you can argue between the Quipli share and some of the other ones, you've got, multiple folks who are interested, and they're all at different stages in where they are with their national growth plans. They have different density in different markets. Somebody may have everything they want, and somebody may have not even broken into that market yet. So the independent players have an individualized story and potential fit with each of those players. So now you have a very full market. And what we think about for strategic buyers, if you're just going to look at it as in a very simple way, is probably the more interested I as an owner are or am in selling and transitioning away fairly quickly than the larger, doesn't have to be the largest, but the larger multi-regional or national players have the existing regional and local management to affect that, right? So Karen Zajac at Norris, probably the biggest independent in Philadelphia at that time, she had an interest in transitioning away from the business. So United ends up being a perfect, buyer, or a large strategic ends up being a perfect buyer. We sold a business called Liftworks in Chicago, and Marty up there was interested in transitioning away. Sunbelt, with its density in that market, ends up being perfect. You have other players though that are not interested in transitioning away, right? They want a partner, they may want liquidity, but they also want to keep growing. And so there's where a financial partner can come along, provide substantial liquidity, but allow that independent company to stay independent, keep growing, and maybe explore a different exit. So the more, in a sense, the more somebody wants to kind of stay and grow, that financial investor may end up looking like a better fit because it would be cash and valuation today, but also another bite at the apple, a few years from now, to the extent that somebody is more interested maybe in starting that transition more quickly, then the corporate buyer, usually can provide that, that exit ramp a lot more easily.
Yeah, that's a great point. So if you're sort of done with your rental business and you've had your moments and you want to transition out, the corporate buyers are potentially the better fit. If you want another bite at the apple, you want to keep going, the financial buyers potentially a better fit. Am I hearing you right?
Yeah, I mean, in a world where like we're on a roulette wheel and you can only bet on red and black, right? Then I'd say that's true. Now, every story would have different nuances and maybe there's exceptions in both ways, right? But if you're just saying in general, that's a fact that tends to lead to one type of buyer more than the other type of buyer.
One thing that we hear a lot about is every time there's a rental company acquired, which by the way, I think in this 12 to 16 months we've done this podcast, 4 of our guests have been acquired, have been part of an acquisition. So it's happening. Is that increasing, or like where does this go in 5 years and 10 years? Is there a spot for independents to thrive and win on customer service, or is that market, that middle market, lower middle market, does that just go away long term? That's something people talk about. I'm curious how you guys think about that. Is there a place for independents to thrive in the next 5 to 10 years with what seems like increasing consolidation from the national players?
Yeah, happy to jump in on that one. We can certainly see, right, how some might have a concern about the pace of strategic consolidation, but we believe that the middle market really does and always will play a very important role. I think the latest data that I've seen says that there's something like just under 4,000 total U.S. rental companies in the market here. And those 4,000 companies represent something like 9,500 or 10,000 branches overall. And it's about 50% of all the locations are with companies that have 5 or fewer branches. So it's still, a vast amount of the actual branch footprint is held by independent companies, middle market companies. And, we repeatedly see how customers, particularly the smaller and mid-sized contractors, really prefer to work with the independents because of the superior customer service that they offered, like David mentioned. For this reason, our clients generally are telling us that the nationals sometimes are the easier competitors to actually compete against and win against, because with the smaller mid-sized contractor base, it's just they are much better positioned to serve those needs. Today, I think United and Sunbelt and Herc, they all account for about 30% of the overall market. And in the future, if you ask Sunbelt, they put out in their materials that they anticipate that, at one point in time, that them and a few others will have something closer to half of the market. So while that is very significant scale, you still have thousands of other companies representing the other 50% of a continuously growing market. So today, I think the market is now it's crested $60 billion. And at one point in time, it was, $10 billion. It's continuing to grow each year. I think this year it's still 9% growth over last year. And U.S. rental penetration is still lagging considerably behind some other developed nations and other places like parts of Asia and the UK. It's closer to 80-85%, and we're at like a 60% or so rental penetration. So there's still room to go from there. So I think while those large companies continue to grow, you're still talking about tens of billions of dollars of opportunity for the middle market players to keep capturing share. So overall, we still remain very bullish about the opportunity for middle market independence.
Yeah, I'd say if I could just jump in, there's a couple of things just because the scale of the industry, you can almost so imagine a $60 billion business growing somewhere between 5 and 10% compounded annually. Okay. So that's between $3 and $6 billion new revenue every year. Okay. So let's say the big 4 or 5, capture their 30% of that. Okay, well, that's 1 or 1.5 billion. There's still 2 to 3.5 billion that's left for the rest of the market. That is another United Rentals being created every year. Every year. That's how much net new revenue is. And that's at, and so the pie is getting so fast that even as the big keep getting bigger, the pie is getting bigger. We continue to see that. Here's a difference, Kyle. A few years ago, if we met a rental company that had 3 million of EBITDA, okay, we might bump into them a couple of years later, and they might be 5 or 6 million of EBITDA. And I'm talking about a few years later. Today, we're bumping into a company with 3 million of EBITDA, and 18 months later, it's 8 million of EBITDA, right? Mm-hmm. Rapidly creating value and scale, and with that, potential external interest, right, in it as a company. And, and one thing that we see over and over again, and we'll see it with the strategic buyers, anytime they buy a significant independent, what they generally know is they're not going to get 100% of that revenue, right? Those contractors, small and mid-sized contractors, are already with an independent. They could go down the street either way and be with any national they want. They're with that independent. When they become part of it, they don't get 100% of that revenue. That other revenue sloshes over the top and goes back into the market to the next set of independents, the next couple of most competitive. And so all of a sudden, in a year or 18 months, there's really net new revenue that just falls into the local lab. So by just the scale of what 5 to 10% growth a year generates, the service dynamic, and the fact that even as folks consolidate, there's a set of people that will continue to move to the next strong independent and partner with them.
Yeah, a lot of good nuggets. I guess 2 follow-up comments. One, Michael, it's sort of like you said, if you ask United, there's some about 30% market share between them and United. If you ask them what it'll be, in my mind, if you ask them what it'll be long-term, they'll tell you 100%, but right. They're very bullish. But I think, David, what you just said was very interesting. So you're saying just from the natural organic growth of the rental market, effectively a new United Rentals is being created every single year. Obviously, that's from a revenue perspective, that's being split up across a lot of different groups, but that's how fast the industry is growing. Did I hear you right?
Right. And I can't, from where I'm standing, I don't think I know United's annual revenue right off the top of my head, but it's going to be plus or minus that. So take that as just a directional comment. But that's, you're creating one of the 1 or 2 largest industry players every year. That's how much revenue is up for grabs every year to go. Wow. And then the second thing is you've got population migration, because, let's say you're in the Northeast, right? And there has been obviously population migration from the north to the south. You've got population migration happening from California, west to east, okay? So all the infrastructure and water infrastructure and bridges and everything that was in the old area is still there, and all still has to be maintained, right? And now you need new stuff. As human beings pick up and move from one place to another, you need the human infrastructure, the roads, the hospitals, the water treatment facilities. Even as people move out of Dallas into the surrounding concentric rings, the movement of 5 or 10,000 people requires a significant set of infrastructure that will be built to support that. And so even in a world where we look at things as static from a physical asset standpoint, we look at population migration driving. Forget the infrastructure bill or the CHIPS bill or the aviation bill. Just human migration is driving net new construction of everything. Even if population doesn't change, even if population shrinks, as long as it's moving, it's good for the rental industry.
Yeah, consolidation aside, sounds like being in the rental industry, it's a great time to be in the rental industry, right? It's growing that fast. It's going to be here for a while. Just the natural growth. Like I think before the call we were talking, just the rental penetration in the U.S. is lower than other developing nations. Like there's just like a natural organic growth that is sort of, rising tide benefits all boats sort of thing. That's happening in the rental industry, and maybe we're still very early in sort of that natural growth.
Right. There's 2 sides of it. I mean, at a higher, broader level, in that low 60% range. It continues to tick up by a percentage point every year. And then you also have, this specialty category that everybody's talking about, right? Where that's more in the 15, 20% range, continue to tick up every year. But what we're generally seeing is, this concept of rental penetration is just continuing to drive greater rental reliability, which is sort of this virtuous cycle of you have equipment availability with expanded functionality, greater proximity, just more branches, throughout the country. And that in turn, that drives a more efficient market and more affordability for the contractor. So all of that sort of this self-feeding cycle that continues to drive this percentage point increase per year of rental penetration.
There's
We
several
use that word reliability. Yeah, we use that word reliability, right? Because if you're that contractor, if you're skeptical or if you've been burned, right? You pick up the phone, you call your rental house and you call two others and they don't have what you need, you're in trouble. Then that's going to lead you to want to own that piece of equipment. But if you migrate into a world where 90% of what you need, your primary, rental partner can solve it. And if they can't, you're one or two phone calls away from getting it. And it's very close by and well priced. You now have very little incentive to tie your capital up in your owned equipment. That's where that rental penetration rate continues to move. More and more contractors can build a contractor business, relying less and less on what they actually own, more and more on what they know they can get their hands on at a good rate and know it can get it fixed, right, very quickly or replaced very, very quickly if something goes wrong.
Yeah, exactly. The service piece is so important, and being able to have the right equipment at the right time, very important, right? Because if you don't have it, you're losing dates on construction site. That's real money, right? And that's why, that's where rental companies can win quickly on the service side. One thing that I really like about what you guys offer is you do these annual industry reports and also the quarterly reports. And Michael, I was reading the Q2 report you put out. I think people are always very interested in, okay, great. Thank you for the history. Thank you for the future. But what's happening today? What do I need to know today about what's happening in the rental market? Can you guys just summarize a little bit sort of what you guys saw in Q2? It sounds like rental rates were still strong and holding price integrity there. And transitioning maybe where we are almost halfway through Q3, what are some of the things you're hearing from some of the rental companies you're talking to?
Hey, Michael, before you jump into that, the last few days of the market, I just want to make a comment. The reason for a quarterly report is if you watched Bloomberg or any of the financial news from Thursday, Friday, and Monday, that is why we created that report. Because people get very focused on the stock market and the ups and downs, and, oh my gosh, and recession and all this. And then we're looking at what is actually happening on the ground, right?
Right.
And where are we in infrastructure spend? And how long is this runway, which is a decade plus? And we were frustrated that folks were getting up and watching Squawk Box or something in the morning and getting, depressed when the sector has probably the best tailwinds behind it for the next decade of any other time. So the last few days actually are the reason we started putting that out to stay focused. And Michael, take it from there on the direct question.
Yeah, I mean, equipment rentals and sales for that matter are really closely tied to the performance of downstream markets. So ones like David mentioned, infrastructure, reshoring, semiconductors, industrial, resi, and commercial. And there's been really just robust activity and capital deployment across these downstream markets that have helped support nice organic growth over the past few years. There's significant public investment in national infrastructure. There's this growing shortage of residential housing, shifting demands, and kind of commercial space needs, just based on how the economy has evolved over the past few years. And that all will support meaningful growth over the next few years. In terms of what the ARA is saying right now, they just released the latest forecast a few days ago, and that pointed to, at a headline, right, that says a slight softening in demand. Now, that's primarily more for the general tool segment. On the construction and industrial rental side, that growth remains just about unchanged. And the industry is still expected to grow in 2024 by about 9%. So while it may be softening, it's really softening off of, all-time record years of 22 and 23. So it still is substantial net growth. It's just a little bit less than was expected. And if anything, I think what we're hearing across the board from companies and seeing is more of a normalized demand environment coming off of those years. So companies, have had 2 record years, and now really with equipment availability up and some rental rate, I think moderation, it's now a lot more again about competing on, value proposition and service. It's not just, do you have the equipment? I'll take it at any price. I think there's a little bit more price elasticity going forward now. And I think that's again where middle market companies can really differentiate themselves in the customer service that they offer. And to David's point, you can kind of watch everything on the news and, be very alarmed about the state of, the construction market. But even, just looking at some of the latest quotes coming out of earnings calls from United and Sunbelt and others, I mean, United went ahead and said that, they still are very positive because they're just listening to what customers are telling them on the ground. And those customers continue to be very positive about the outlook. And they're kind of implying that you need to put less focus on all of the noise around individual kind of micro volatility of the ABI or Dodge Momentum Index, and just kind of focus on, what work is being done right now. And a lot of that dovetails into all of this infrastructure deployment and chips and semiconductors and airport, construction and all of that. So I think, once we start to see some interest rate decline, that will help take maybe some of the smaller projects off the sidelines that are a little bit more sensitive to that. I think on the mega project side, those are still just pushing forward. But overall, what we think is indisputable is that the rental model and the value proposition have really never been stronger.
That's a great point. And I think, if you read the news, you can not get out of bed in the morning, especially this week, August 7th. So you listen to this later on. We had an interesting week in the stock market. But you guys, what I really like is you put that report out quarterly to sort of level set. Okay, guys, let's not worry about the day to day, but let's talk about the next year, next 5 years, next 10 years, where you guys are saying it's stronger than it's ever been. And with all the different tailwinds you're talking about, there's a lot to be encouraged by if you are a rental company. Is that right?
Yeah, absolutely.
Yes, we were just on a phone call with one of our other partners who's very, very active, as we are, but very, very active across broader building products, especially building envelope, and looking at the backlog of even commercial for 2025. And that customer base is saying 2025, the top's going to blow off because there's been a lot of projects that have been delayed. And one of the elements when you think about, and I'm not going to say we're experts, I'll just say this, and there are people in this phone call that probably live and read this more, but when you think about a construction project, you're going to have the construction financing, and then you're going to flip into your permanent financing right at the end of that. And one of the things about this economic outlook from the Fed, which is, hey, there's going to be, rate reductions, rate declines coming. It kind of encouraged everybody to just hold off a little bit, right? If rates just went up and stayed, everybody would build. Right. But it's the fact that it's not even the fact that they ran up. It's the fact that the expectation was they're coming back relatively soon. So pause, wait for rates to come down, wait for that to be in place. Now I can go on and finish my construction, realizing that when I get to my permanent financing, I'll be 75, 100, 125 basis points cheaper on my permanent financing. And so that's why there's an outlook that 2025, a tremendous amount is going to unleash once you get 1, 2, 3, 4 rate reductions. They don't have to wait for them, right? But they can see that cadence and say, okay, now let's take the next 12 months and finish this project, and then put our permanent financing in place. So that sets up for a great 2025. And for the folks on the phone call, actually 2024 into 25 arguably is a firmer market for valuation. And what I mean is, in 22 and 23, because of the supply chain issues, I could sell a piece of equipment for whatever I wanted. I could rent a piece of equipment, just because I had it at maybe not price gouging, but certainly at a full price. And now we've gotten into a more normalized environment. Well, financial investors and the big strategics, knew that price inflation was in there too. So if you had numbers that are 22 and 23, there was a presumption that pricing level really probably can't hold, right? That's a supply chain induced pricing. And we'll finish out 2024 and go into 25. Now we have a normalized environment. So even a company that might have had steep growth because of inflation, it may have leveled off here in 24. We would say that 24 number is actually a firmer number than the prior two before. And so somebody looking at a business, acquiring a business, valuing a business today, it's probably on steadier kind of bedrock of profitability than people would have looked at the same company and its EBITDA, a year or two ago.
Yeah, it's interesting on the interest rate side. So there's been projects on the sidelines. It's because not that they're high, but it's the expectation that they'll be lower. So let me just wait a little bit longer till the rates come down, and then I'll build. So there actually could be 2025 could actually be a really great year for rental companies if the rates do go lower, which a lot of people are saying they will. 2025 could be a really strong year for rental companies.
Yeah, even remarkably in the commercial side, and that's what I'm sharing is a lot of our clients that participate in commercial construction believe have historic backlogs and believe a ton of that's going to release in 25.
And David, one thing you mentioned was you mentioned valuation and some of those, I guess the drivers. I guess one of my questions is one of the topics I want to get to is what are some of the valuation drivers for acquisitions, particularly in the rental industry? What are the things that drive up value? And specialty equipment usually does, but what are some of the things that you're a rental business owner with a dream to sell one day, 3, 5, 7 years out? What's going to drive a higher price, and what should these rental company owners be thinking about?
Yeah, so there's a number of drivers, right? It's kind of a holistic picture to look at, but any number of these can help drive value. So starting out with just scale of the business. So the market share or the presence of, what we think of as platform attributes, and we can get more into that those scale and market share and platform attributes can help support a robust acquisition strategy. Next, really in the rental industry is the concept of density and clustering. So density, rental companies that achieve market density generally, right, they'll attract the acquisition interest in particular of national consolidators who may be looking to increase their density in that market or get into a new one, just with like an immediate, large scale entrance into that market. Customer mix is another important one. So us having a solid mix of small to mid-sized customers who provide revenue diversification, a concept of reoccurring revenue. So it's not necessarily contractually recurring, but these customers are coming back time and time again, very sticky relationships. And those are the customers who really appreciate customer service and product knowledge. The resiliency of the end markets that the business serves. There's really outsized value that's generally ascribed to a business with a customer base that's serving more resilient and cycle-resistant end markets such as infrastructure and utility or, water treatment facilities, roads and bridges, things that support, the population migration. That sort of goes hand in hand with geographic tailwinds. So we're seeing a definitely, companies that are in those Sunbelt regions that are the Sunbelt states that are getting a lot of net new population migration are, that are really benefiting from a lot of infrastructure investment. That is something that's viewed very attractively. Specialty is another one. National rental companies, they're focused on building out their specialty offerings, and that reflects a lower but pretty rapidly increasing rental penetration rate. And a few others probably would be the age of the fleet is important. That's certainly one that's very, is within, an owner's control to think about. An average rental fleet age of something in the 3 to 5 years range is perceived as more conducive to keeping maintenance and downtime costs to a minimum and having more uptime. Management continuity, that's another one that's really important, especially for a financial investor. So on a strategic side, that if you're looking to transition out of the business and, maybe retire, or perhaps, you just, you don't have kind of a next person lined up, whether it be family member or someone else, that's where for the financial investors, management continuity is very important. But on a strategic side, that's a way to kind of hand off the business, so to speak. So for financial investors and international strategic buyers that don't necessarily have feet on the ground all the time in the same country, it's helpful to have that next level of management to really be running the business. And I think the other two would be synergy opportunities. So especially for a strategic, their ability to pay is really heavily influenced by the perceived synergies that the target possesses. It could be revenue synergies or cost synergies. So revenue synergies like pricing optimization, clustering of locations, and maybe cross-selling of some specialty equipment or just other equipment categories. And on the cost side, that could include optimizing, improved purchasing, logistics efficiencies due to the same clustering, or introducing new customer-facing technology that helps eliminate, some inefficiency or reduce standalone expenses. So those are all attractive, those kind of all elements that help to drive value. Probably one more I should have said is just organic growth. That always helps. I mean, I think if you're an independent rental company, if you can point to solid organic growth for the past few years, you're kind of timing your exit with the market somewhat. You have an attractively aged fleet. You have a kind of next level leaders in line, and you're serving customers who are clearly very sticky. Those relationships are coming back to time and time again. I think those are some of the key drivers if you're, middle market independent, thinking about, what your long-term plan is.
Yeah, that's great. I mean, ultimately, the summary is do you have a very strong, healthy underlying business, right? And what are the things I look at? It's customer mix, market density, the geography you're in, specialty equipment, fleet age, 3 to 5 years, which sounds like the sweet spot. Management continuity, right? They want to know who they're buying. And if it's not going to be you, who's the next generation leader to step in? Mm-hmm. Synergy opportunities or organic growth, all those things sort of come together. Some of these things you don't have as much control over, right? Because if you've been taking over your grandfather's rental business in Atlanta and your family's in Atlanta, that's your geography, right? So,
right.
For better or worse, right? What are some of the things that are most controllable for rental owners who are like, all right, I want to be out of here in 5 years, or at least have an exit in 5 years, and maybe I'm going to stay on. Fleet age is probably something they can start upgrading over time, right? But what is maybe one of the top 1 or 2 things that rental owners can control that will increase their valuation?
I think fleet age is one. Certainly management, like they can think about how they want to position that, right? If their goal is to kind of move out of the business, then maybe it's more, it might be better aligned with a strategic who has the management team in place to take that on. But if they're thinking they might want the second bite of the apple and work with a financial investor, that's something that they'll look for. So even in a case, it still could be though that they're seeking to ultimately transition out, but maybe they have to stay on for another 18 to 24 months just to help with the transition. I mean, a financial investor can ultimately, work to find a new leader for the business. Maybe it's elevating someone from within or bringing someone in from the outside. And then I think in terms of other things that they could potentially control, probably, on the customer mix side, it's a little hard dependent on who's in your market, but, they can think about how is their product mix strategy working? Is it serving the customer base appropriately, or are they seeing particular growth in specific product, category classes? And maybe they'll start to think about investing a little bit more in some of those other classes, perhaps divesting and using the proceeds from those, fleet divestitures to help support growth in investment in one of those other areas. And it might just be that if they become maybe a little bit more of a, not specialty in terms of specialty equipment, but specialized in a certain category or end market, that could then make them, a leader in their local market. And that again would attract interest for someone coming in who really wants to just have sort of a dominant position in that given end market or customer type. But to me, those are some of the elements I think you have a little more control over.
That's great. Now, on the customer mix side, I've heard from several people, if you have a great customer service and great rental business, 90% of your rental transactions often can be recurring from repeat customers, right? So if you're serving your customers well, they're going to keep coming back. That's a huge part. It's not recurring SaaS revenue, but it's like recurring customer retention, right? That's a huge part of the valuation. One thing you also mentioned briefly was international buyers. Are you seeing Is that increasing in the United States? Are there other, I guess, buyers located outside the U.S. acquiring groups in the United States?
David, you want to jump in on that one?
Yeah, that's where, interestingly, maybe a couple of two or three things come together. Scale becomes very important, right? And so think about scale as, I don't know, 15 to 20 million of EBITDA or higher. So not, either a very large independent in a major market or a very, significant regional player or even a super regional player. If you look at the European big rental houses and the Asian big rental houses, they really have not, none of them really made big moves into the U.S., which is really bizarre to me, because, we're a gigantic homogenous country that's, has got lots of, economic and political and legal stability. And even the biggest players in Europe, and even after the EU, that's still a very choppy, multilingual place to try to operate, right? And so we continue to see some of the bigger players in Europe taking a look at some of our larger transactions and kind of getting sequentially more interest. We really haven't seen the big striking move yet. Mm-hmm. But we worked with one of the largest rental companies in the country at the time. And it was in a major market. And we had many of the international players very interested because if they were going to come to the U.S., that was a region and a scale that was going to be hard to see again for a little while. And so I think that's it. But they too need existing management. Like they don't have a regional management team and 300 branches already that you could just fold into. So both financial investors and what we've seen is the international investors really value that continuing management because they don't have the ability to immediately replace it.
It sounds like a lot of people are waking up to how attractive the rental business is in the United States, how quickly it's growing, and maybe some of the international buyers are taking notice, even if they haven't jumped in yet. They're monitoring. That's sort of what you guys are hearing. It sounds like.
Right. And look, it's also a tough world, right? If you come over here, congratulations. They view needing to create, to compete at scale with United and Sunbelt and Sunstate and Equipment Share and H&E and Hurt and. So it's not like we're fragmented and you can just jump in when, you can jump in and then you wake up the next day and now you're competing at scale with large players. And so I think that's created a tension. Interestingly, on the equipment dealer side, that's an area where we've been seeing the large, especially candidly in the Volvo category, the largest player in Africa, a Volvo dealer really conquered all of Africa for Volvo, has made major investments here in the U.S. The largest players in Northern Europe have made investments here in the U.S. So we've been seeing some of the large dealer international groups actually get into the U.S. And we've heard stories about them really telling the OEMs, hey, I did the hard work for you. I built out the Middle East. You got to help me get some dollars here in the U.S. where it's just a little saner. Certainly, again, large homogenous market. So we'll see a big international rental acquisition one of these days. But we had to bet we would have thought it would have already happened, and it still hasn't happened yet.
That's right. Well, I'm glad you mentioned the dealers. That's a topic I wanted to ask you guys about because we're seeing it as well. Seems like to me there's an increasing amount of dealerships expanding into rental. I know you talk to dealerships as well. I'm curious, what are you guys seeing on that front? Some of the opportunities and challenges for dealerships thinking about expanding into rental.
Yeah, I mean we're increasingly seeing dealers add rental to their offering. I think for a few reasons. One, rental just helps them expand their wallet share with existing customers. It helps them win new customer relationships as well. It has really a nice benefit for diversifying EBITDA generation and contributes really good, gross profit EBITDA margin contribution. Once you, kind of take out, the rental depreciation from the equation, it's, these are 80+% EBITDA margin contributing lines of business. In terms of the scale of those rental fleets, what we have generally seen now as dealers continue to add rental for those reasons is a sweet spot is somewhere between 10 and 30% of revenue, total revenue coming from rental. So that often reflects high utilization, longer term rentals, or maybe some rent to own contracts. But it's in that 10 to 30% range that a dealer can generate attractive EBITDA margin contribution, but it doesn't have such significant CapEx. And that can be helpful for, financial investor looking in who, might, otherwise like they really protected territories and parts and service margin, but, there's a kind of a sweet spot where you have fairly low CapEx, but high EBITDA margin contribution. I think in terms of challenges, when we do see dealers add rental, in one side, it's often subscale. So a lot of times we'll see that maybe it's only 5% of their total revenue. And that means they have to start turning away opportunities just due to lack of equipment availability. And we're increasingly hearing that OEMs are telling their dealers, we want you to get your rental revenue to the 10, 15, 20% range. So the OEMs are thinking about that as well. And also the other challenge is that a lot of dealers don't often manage their rental fleet as tightly as the rent-to-rent player. So their mindset a lot of times would be to sell equipment, and rental can bring in some extra business. So we often will see dealers might be shortchanging their rental and then not getting the right return because the rental providers over here, they're really asset managers. They're micromanaging their pricing, their seasonality, utilization, and the dealer is still thinking, everything is for sale. So our recommendation generally to a dealer, if they really want to get into rental, is establish, if you can, a dedicated rental fleet and just micromanage it to maximize returns.
Yeah, I think it's hard to do one thing well. It's hard to do two things well, right? Even harder, right? And we've talked to a lot of groups, dealers who, it's 3% of the rental revenue, and it's of revenue is rental, and that's hard to do well. What you guys are saying is you got to be at least 10%, 10 to 30% of a total dealership revenue should be rental if you're gonna actually make that a dedicated focus. Is that right?
Well, I say that's a kind of a sweet spot. I switch something around. If we're selling a dealer that has some rental, but we think it's subscale rental, that's not a bad thing. In fact, it's a good thing. It's an opportunity for a new investor. And we're talking to a family office or a private equity group as part of that. We're pointing out two things. One, we think there's an opportunity to grow rental fleet, not to 80%, but certainly more than 7 or 10%. Okay. And that'll be a very good EBITDA contribution. That'll help drive growth and some future value. But at the same time, as you get that to scale, please take, a big slug of that and make it a rent to rent fleet and start capturing, what you're helping your clients do, capture that, what we call the longitudinal data over time. So you can micromanage by cat class, by seasonality, by customer and project migration, right? If stuff's always dropping in and being sold out, your data is never, it doesn't give you comparative, comparable comparative data over time to micromanage it. So we'll say, number one, grow it. And then number two, put a rental manager in there and a real rental system in there and get the data and then manage it better. And so you'll create more EBITDA and then even more EBITDA margin out of it. So that's two big pops. And that's where I think we know some of the financial investors who have come into the dealer side recognize that. Now the flip side for the rental folks that are on this phone call, on the one hand, most of the dealers that we see that are in rental are not in day-to-day, week-to-week, or even a month, right? If they're renting, they want something to kind of go out for, a month, 2, 3. They don't have the infrastructure to turn and PM and clean and re-ready fleet. They don't have the trucking and the logistics support, right? So on the one hand, they're not competing maybe day to day with every rental house in some core business, right? They're competing for maybe the longer duration project. So that's good, right? The bad thing is because many of the dealers bring a sell side mentality, renting it for a while, then selling it, kind of ends up being way better than just selling it today. And so they may be putting some pricing out there that's not as, it's more competitive, right? Because they're looking at it from a different frame of reference, right? They're not looking at it as a rental player trying to maximize their rental fleet. They're looking at it as a a sales-oriented organization that's using rental for many other things to drive the overall business. And so they can be, the good thing is they don't necessarily compete every day. The bad news is when they do, they may be a little tighter on pricing because they're thinking about it in just a totally different way than your 5 other rental competitors. You probably all have almost the same rates in a market because you all know exactly what the equipment costs. You know what your returns are. You're being smart. You're being good competitors. And then here comes somebody that's kind of a little bit lower, but sometimes that's just from a different mentality, a different strategic goal.
Yeah, it sounds like a tremendous opportunity for dealers who are 5% of revenues rental. There's a lot of meat there that you can grow into with dedicated rental manager, dedicated software for it, dedicated rental fleet, dedicated focus. I mean, there's low-hanging fruit, which it sounds like you guys are seeing when you're talking to groups about selling their company. That's actually a good thing to leave something on the bone for the next buyer too, which is interesting. I know we just have a couple minutes left. I just want to get to one more topic, which you guys briefly talked about, which was strategic versus private equity or financial buyers. Let's just say, Michael, I went through your list of the 10 things I need to do to increase my valuation. I got everything lined up, and I'm ready to think about an exit in the next year. What are some of the pros and cons for selling to a strategic, United, Sunbelt, et cetera, versus a private equity firm? How should I be thinking about some of those trade-offs?
Yeah, I mean, and I don't know if it's even trade-offs. I guess it really depends on what your individual goals would be. The strategics are generally, they're buying another rental company to either expand into a new market or increase density in an existing market. And, we have a lot of clients, right, who they may just have, they just may never want to sell right to that one strategic. And that is absolutely fine, right? It's their business. I think, in cases of some of the clients we've seen, right, it's generally, someone doubling down in the Texas market, or it's, Sunbelt buying, Liftworks in Chicago to increase density in the Chicagoland market, United buying Norris to take majority share in Philadelphia. So sometimes I think strategics, they're more heavily influenced by the perceived synergies that the target has. On the financial side, they're really increasingly drawn to the sector because they're thinking about these compelling industry tailwinds that we're seeing. They like the attractive financial profiles and returns on assets of rental. They get very excited if there is this actionable opportunity for a buy and build story. And that's something where, as a private owner, if you have a long runway to go and you want to continue growing the business, you can partner up with a financial investor who's going to give you access to greater capital, and then you can build out, a buy and build strategy and really become your own kind of consolidator of the market, or greenfield, and expand that way as well. For financial investors, the other thing that's helping them increasingly get into rental is they see that there's a well-established ecosystem of exit opportunities of other strategic and financial buyers out there. And, we generally see this sort of market arbitrage opportunity, as David likes to call it, just based on the continued sort of reticence of the broader financial investor universe to compete appropriately in rental. So I think if you're a business owner that, you've got a long runway left, you really want to continue driving growth, but maybe you want to take some chips off the table and, kind of diversify your own portfolio, but just continue to get to grow the business and then have the opportunity for a second transaction in the future, a financial investor can be a really great partner for you. And they focus on that platform DNA, kind of the brand recognition, the scale, strengths of the management, your customer relationships, and having a clear M&A story is really helpful for them. That's what gets them excited. And then on the strategic side, it can be, if you find the right partner, that's the right home for your business's employees, it can be a more seamless way to kind of transition out if that's what you're looking to do. So there's really no right or wrong way. It just depends on, what your individual objectives are.
Yeah, that's great. It really comes down to what the owner wants, and there's not a better right or wrong way, as you said. So I appreciate you guys coming on. I know we're just out of time here. It's been an awesome episode. I think it's an exciting time to be in rental. I feel encouraged about what David talking about. And, David, I love your point around effectively the revenue of United Rentals is being created in the United States every year from the rental industry, and, sort of the infinite mindset, expanding the pie type of thinking. Yeah, there's going to be competitors and consolidate, but it's growing so fast, a lot of people can win, and that's a great market for us all to be in. So exciting times ahead for the rental industry.
Absolutely. Well, we appreciate you having us on. Yeah, this is a lot of fun.
Cool. Well, thank you, David. Michael, I know you had some challenging logistics issues flying in this morning, but I appreciate you guys coming on, and awesome episode. Thanks again, guys.
Absolutely. Thanks for having us.
Yeah.
Thank you so much.
Thanks.
Take care.
Bye. Everyone.